immaculately and double your money. And after all that, you've doubled your money, you haven't made any progress at all. Okay? A 50% loss followed by a 100% win equals you're exactly where you started. Okay? So the whole point of radioactive trading is to concentrate our losses right here in this area. Because after all, a 5% win requires a 5.3% gain to get back to even. Okay? But a 25% loss would require a 33% gain to get to even, and 33% loss would require a 50% gain, and so on and so forth. Okay, let's remember this number here. 33% loss requires a 50% gain. Okay, and with that, I'm going to, whoops, how do I'm going to open up another poll. Okay, and ask what is the method of money management that's being used by folks online. Okay, and if you use more than one, choose the one that you think is keeping you out of the soup the most, or the one that's helping you the most. Okay. We've got some folks that are highly diversified. We've got some folks that are using stop orders. Very often I see hold till it hurts. Yep, I just saw at least, a few. A couple of folks have answered that, hold till it hurts. I wonder how that strategy has worked out over the last, 8 months or so.
Well, that relates back to that 33 and 50% loss, because that's where most mutual funds are now, right? So if you're holding to the end, you're looking at that.
If we have a 33% loss, we need to have a 50% gain based on where we're at now, just to get to even, right?
Mm-hmm.
Ouch.
A lot of people are seeing numbers like that, I bet, unfortunately.
Yeah. Okay, this is really interesting. We must have a number of folks on the line that are divisible by 4, because guess what? Can you see that?
Yes, sir.
Yeah, 25, 50, and 25. How about that? Okay, 25% say hold till it hurts. Okay. I guarantee, Mike, that this 25% was not in the 8% that said that they were happy with their trading for last year. Okay, if this is your method of money management, you're going to get hurt. Okay, 50% are using stop orders, and I like to say that there's nothing wrong with stop orders except for what's wrong with them, and we're going to look at that here in just a minute. And 25% of you are highly diversified. Well, okay, good. Let's hide the results. Let's talk about those methods, and then let's talk about why the radioactive method works so well mathematically. Okay, it's not just a theory. I've proven it. Stop orders are simply a market order, aren't they, Mike?
Mm-hmm.
It's when you place a market order, basically you say, okay, sell this to me at whatever you want to, or buy this from me and give me whatever price you think is good. And that's really not the way to go. Usually when I'm trading, I don't use market orders. But essentially a stop order is nothing more or less than a market order that just becomes active when your stock is moving against you. Okay, and it's a good way to put your stock on autopilot, I suppose. And in fact, it's what I used to use. But I found out something really bad about stop orders. The first thing that I found out that was bad was that I could predict the future. And don't laugh, okay? I could actually predict the future. Okay, and here's the deal. Let's say I bought a $20 stock, and I set an $18 stop loss order, okay, so that if that stock went down to 18 bucks, I would be selling. Okay, well, guess what there, Mike? I found out that I was able to predict the future. That stock was going to trade, the lowest it was going to trade that day was going to be, guess what?
$18.
$18. And it'd get taken away from me, and I'd see it go back up to 19, 20, 21.
Mm-hmm.
I'm like, what's going on here? Now it's at $23 a share, but I sold at 18, I predicted the future, sure enough, but what I did there was I set a stop too closely. Now, if you set a stop not close enough, you expose yourself to greater loss, right?
Oh, yes.
But if you set your stop too close, you get shook out of your position, and the market maker says, oh, cheap inventory, goes and picks it up, and then he sells it to somebody else, and that kind of hurt, okay? But here's the really big problem with a stop order. Because it's a market order, let's say I bought Daktronics. I just saw it pay a dividend, did a 2-for-1 split. The earnings are up 18 cents a share. Investors Business Daily doesn't have enough good things to say about it. It's got an A+ rating in fundamentals, A+ rating in technicals, and I say, okay, you know what? I'm going to get it. And I get it at $30 a share. Okay. And then it goes up to 32 or so, and I say, you know what, I better protect myself. So I set a stop loss at $30. Okay? Well, what happens if it's August 16th, 2006? On August 17th, 2006, it opens 35% lower than it began. Now, remember I said, 33%?
Mm-hmm.
Look at this volume. 15 million shares almost in one day when it's humming along usually at less than 1 million shares. Okay, and I'm at the end of a very, very long line, and I'm getting out of this position. The best case scenario is a 30% loss, but probably I'm going to lose more. Okay, it's really not a happy thing, and that is what a marketer can do to you. Here's insult added to injury. Okay, if I bought around here at 30, and I had the ability to hold on through here, I wouldn't at this point have any knowledge, have any guarantee that it was ever going to come back, right?
Oh, right.
But if I did have the intestinal fortitude and strength to hold on anywhere through this 4-month period here, I could have sold at a profit. I could have made quite a bit of money.
Mm-hmm.
Isn't that something? Okay. All right. So the stop order itself is not the answer. The stop order is simply a market order that gets worked against you when it's worst. Okay. What about diversification? Some folks rely on diversifying their portfolio for risk management. Now, here's the deal. I diversify too, but I don't diversify for risk management. I diversify to spread my net to try and catch more winners.
Mm-hmm.
Okay. The theory with diversification is that, hey, I'm good enough at picking stocks. I'm wiser than the market. I know that if one issue's down, all my others will be up, and that counteracts a loss. But I have a problem with that theory, okay? What about a large-scale downturn? What if everything becomes undervalued right away? Apple, for example, is making money hands over fist. What did everybody want? I'll tell you what, I got 3 kids. 2 of them are teenagers. You know what everybody wanted? Everybody wanted an iPod.
Mm-hmm.
For Xmas here, everybody wanted an iPod here. And the thing is, well, Apple may be doing well, but Apple stock is not doing well. Why? Because of the large-scale downturn. Because everybody taking their money out of the market, getting scared with all these reports of the bailout, other factors. Okay. If there's a large-scale downturn, does your diversification help you? I don't think so. It gives you 35 bad positions to manage instead of just a handful. Okay, and I think it lacks focus. So this martingale problem, also known as gambler's ruin, is responsible for the mean and nasty portfolio eating losses. Okay, even if you're right most of the time, you can be right most of the time on your stock picks. You can be right most of the time on your timing, but even one bad trade can evaporate most of your wins. It feeds best in an emotionally charged environment. Okay, if your method of money management is money management, what's that? Or it's hold till the bitter end, or hold till it hurts. Okay, the martingale is going to feed. All right, but he can even thrive with their stop losses and diversified positions. Well, what's the answer? Here's my answer. My answer is to have a legal and binding contract in place that guarantees my position's price up until expiration. If you have just a stop loss order in place, let me give you an example. I had Energizer stock. Bought it November 1st, 2006. November 2nd, 2006, 7-point drop. Blam! It goes down. Well, I wrote to all of my Fission members, hey, that's okay. This gives me a chance to show off. Because Energizer went down simply because the price of zinc had been so high. And I thought to myself, every battery maker faces this same problem. Every battery maker faces the same problem. And do people still need the batteries?
Mm-hmm.
Yeah, they do. Okay. But if I had a stop loss order in place, guess what? It would have just gotten activated. With me, I said, okay, I've got a put option guaranteeing my position, so I'm going to hold. And if you look at the chart for Energizer back in November 2006, you'll be pretty impressed that I was able to hold, even though it had just a serious drop. She came back within just a few weeks. Okay.